Welcome back to our weekly explainer of the GoldMining Loonie account. Today, we're stepping right into the analytical reality of algorithmic trading. We're not looking at flashy overnight success stories here, but rather the unglamorous, disciplined mechanics of navigating market pressure with strict risk management. Let's dive right into episode 05 of the USCAD study series. To really grasp the data we're looking at today, we have to start with our core objective. This is a highly disciplined 25-cent account challenge. The ultimate long-term goal is what we call the road to $100, taking a fractional balance and building it up to 10,000 cents. So this week's data, it isn't about an unbroken streak of profit. It's really about seeing how an algorithmic system handles macroeconomic stress without breaking its discipline. Now, before we examine the micro movements of this specific week, the macro picture is absolutely crucial here. 34.00%. That's our lifetime total account growth to date. I want to anchor us on that figure because it proves that the temporary turbulence we're about to evaluate is happening within a fundamentally upward, proven trajectory of long-term consistency. When you look at the lifetime account equity and balance, you can clearly see a steady stair-step climb. By the end of this current period, the balance is sitting at $3,306.06, and that represents a total lifetime profit of $842.22. As you'll see from historical recovery phases, those moments where the equity dipped but eventually caught right back up to the balance, this really emphasizes the reality of controlled, steady wealth generation. So what caused the turbulence this week? Well, it was fueled by a real confluence of macroeconomic drivers hitting the USDCAD. We had vital U.S. employment data releases interacting with shifting expectations around the Federal Reserve's interest rate path. And at the exact same time, the Bank of Canada's economic outlook and fluctuations in the global oil market were weighing on the Canadian dollar. Together, all of these forces created strong bullish momentum, which instantly introduced market conflict for a strategy that's specifically designed around steady, range-bound environments. Under that kind of macroeconomic pressure, a significant gap opened up in the one-week performance. While the secured balance stayed totally flat at $3,306.06 cents, the live equity actually dipped down to $2,840.39 cents. Because the USDCAD moved bullishly against our prevailing positions, the strategy had to absorb floating drawdown, but it held its nerve to keep the risk strictly bounded. Despite all that temporary equity pressure, the bottom line tells a really resilient story. The account still closed out a net profit of $13.67 for the week, which equals a 0.42% weekly growth rate. The foundational balance just kept moving higher, proving that an account can, in fact, grow while actively managing localized stress. You might be wondering how it managed that. Well, achieving that 13.67-cent gain required sheer selectivity. Literally only 2 trades were closed during this entire reporting period. Both of them were profitable, yielding a gross profit of 13.35 cents plus a positive swap of 0.32 cents. The system didn't force anything. It simply waited out the volatility and struck only when the probabilities perfectly aligned with its strict rules. If we drop down to the 15-minute time frame, that macroeconomic bullish push is clearly visible as a steady upward trend. But notice how the strategy reacted. Rather than panicking or overtrading, the algorithmic system responded with incredibly precise, calculated entries during minor pullbacks. It secured small, targeted profits before exiting. It's essentially a highly calculated read of microstructure within a much larger macro trend. And the raw trade history absolutely confirms that precision. We're looking at 2 distinct buy positions on the USDCAD, executed at a very conservative 0.03 lot size, generating $6.95 and $6.40 cents. Data like this reinforces the fact that a disciplined, methodical progression is always going to outperform erratic trading. It systematically takes exactly what the market gives, according to a mathematically sound plan. Of course, we can't talk about profit without also quantifying risk. For this specific week, the drawdown measured 3.43%. Now, yes, that is an increase from the preceding weeks, but context is everything here. When we compare that 3.43% to the historical maximum drawdown of 26.00%, it becomes incredibly clear that this current environment is highly controlled and operating well within our established safety parameters. The one-week drawdown profile confirms this visually. You can see the drawdown resting at 0 early on. Then it begins to oscillate as that macroeconomic data actually hits the market, peaks near 3.43%, and then retraces. It wasn't some sudden, terrifying drop. It was just the calculated breathing room that a strategy requires when navigating a live, shifting market. So, what does this all mean? The core takeaway from this week's data is pretty straightforward. Long-term account growth comes from boring consistency, not spectacular weekly gambling. Professional-grade trading really is about sitting through floating losses with emotional detachment, entirely content with measured fractional gains like that 0.42% we saw today. The exact moment spectacular weekly profits are chased is the moment discipline is abandoned. As we wrap up episode 05, the account has undoubtedly proven its resilience under pressure. But, as we know, markets are relentlessly evolving. Will this strict algorithmic discipline continue to hold? Or does consistent, unglamorous execution eventually find a breaking point on the road to $100? Join us next week as we continue to track this account's journey with total transparency. Until then, keep your focus on the data.